emigrating to the suburbs and families looking for home offices and bigger yards, prices for the American dream home have skyrocketed.
Hello everybody, I hope you're having an amazing day today. We will be talking about comparing investments from three major different categories. These are real estate, crypto, and gold. Chances are you're familiar with those terms, but we will cover them in some detail. Let's begin with talking about real estate. When you think about real estate investing, the first thing that probably comes to mind is your home. Of course, real estate investors have lots of other options when it comes to choosing investments, and they're not all physical properties. Real estate has become a popular investment vehicle over the last 50 years or so. Here's a look at some of the leading options for individual investors, along with the reasons to invest. If you invest in rental properties, you become a landlord, so you need to consider if you'll be comfortable in that role. As the landlord, you'll be responsible for things like paying the mortgage, property taxes, and insurance, maintaining the property, finding tenants, and dealing with any problems. Unless you hire a property manager to handle the details, being a landlord is a hands-on investment. Depending on your situation, taking care of the property and the tenants can be a 24/7 job, and one that's not always pleasant. If you choose your properties and tenants carefully, however, you can lower the risk of having major problems. One way landlords make money is by collecting rent. How much rent you can charge depends on where the rental is located. Still, it can be difficult to determine the best rent because if you charge too much, you'll chase tenants away, and if you charge too little, you'll leave money on the table. A common strategy is to charge enough rent to cover expenses until the mortgage has been paid, at which time the majority of the rent becomes profit. The other primary way that landlords make money is through appreciation. If your property appreciates in value, you may be able to sell it at a profit when the time comes, or borrow against the equity to make your next investment. While real estate does tend to appreciate, there are no guarantees. Real estate has long been considered a sound investment, and for good reason. Before 2007, historical housing data made it seem like prices should continue to climb indefinitely. With few exceptions, the average sale price of homes in the U.S. increased each year between 1963 and 2007, the start of the Great Recession. This chart from the Federal Reserve Bank of St. Louis shows average sales prices between 1963 and 2019, the most recent data available. The areas that are shaded in light gray indicates U.S. recessions. Of course, the most significant downturn in the real estate market before the COVID-19 pandemic coincided with the Great Recession. The results of the coronavirus crisis have yet to be seen. Amid closures, social distancing, and staggering unemployment numbers, it's likely that home sales will decline significantly. While that doesn't necessarily mean home prices will follow suit, it will at a minimum change the way people buy and sell real estate, at least in the short term. Like the day traders who are leagues away from buy and hold investors, real estate flippers are an entirely different breed from buy and rent landlords. Flippers buy properties with the intention of holding them for a short period, often no more than 3 to 4 months, and quickly selling them for a profit. Real estate can be a sound investment and one that has the potential to provide a steady income and build wealth. Still, one drawback of investing in real estate is illiquidity, the relative difficulty in converting an asset into cash and cash into an asset. Unlike a stock or bond transaction, which can be completed in seconds, a real estate transaction can take months to close. Even with the help of a broker, simply finding the right counterparty can be a few weeks of work. Of course, REITs and real estate mutual funds offer better liquidity and market pricing, but they come at the price of higher volatility and lower diversification benefits, as they have a much higher correlation to the overall stock market than direct real estate investments. As with any investment, keep your expectations realistic and be sure to do your homework and research before making any decisions. Now let's move on to gold. Investors can invest in gold through exchange-traded funds, ETFs, buying stocks in gold miners and associated companies, and buying a physical product. These investors have as many reasons for investing in the metal as they do methods to make those investments. Some argue that gold is a barbaric relic that no longer holds the monetary qualities of the past. In a modern economic environment, paper currency is the money of choice. They contend that gold's only benefit is the fact that it is a material that is used in jewelry. On the other hand of the spectrum are those that assert gold is an asset with various intrinsic qualities that make it unique and necessary for investors to hold into their portfolios. In order to fully understand the purpose of gold, one must look back to the start of the gold market. While gold's history began in 2000 BC when the ancient Egyptians started forming jewelry, it wasn't until 560 BC that gold started to act as a currency. At that time, merchants wanted to create a standardized and easily transferable form of money that would simplify trade. The creation of a gold coin stampede with a seal seemed to be an answer, as gold jewelry was already widely accepted and recognized throughout various corners of the earth. There are both advantages and disadvantages to every investment. If you are opposed to holding physical gold, buying shares in a gold mining company may be a safer alternative. If you believe gold could be a safe bet against inflation, investing in coins, bullions, or jewelry are paths that you can take to gold-based prosperity. Lastly, if your primary interest is in using leveraged profit from rising gold prices, the futures market might be your answer. But note that there is a fair amount of risk associated with any leverage-based holdings. Finally, cryptocurrency. The popularity of cryptocurrencies have been growing rapidly in India since last year as more investors try their luck in the lucrative virtual coin trading space. Indian cryptocurrency exchanges confirmed that they are adding people to their platform at a faster rate in 2021. In view of the rapid customer base growth, cryptocurrency exchanges are optimistic that the emerging asset class will keep attracting more investors in India. However, the amount of cryptocurrency investments in India is only a fraction of traditional investment class assets like equities. The trend indicates that while younger Indian investors are placing their bets on crypto assets instead of traditional options, a larger number of individuals still remain hesitant, even though as they are keen on exploring the cryptocurrency space. Well, is it safe to invest? The answer to the question is tricky, as it is still an emerging asset class and has not yet gained widespread acceptance like equities, commodities, and mutual funds. Whether investing in cryptocurrencies is safe remains a hotly debated topic in the financial space, with many backing the decentralized digital currency and an equal number of people opposing it. Cryptocurrency is a relatively new entrant into the investment world, with the first cryptocurrency, Bitcoin, created only in 2009. However, crypto has been all the rage in 2020 and 2021, with numerous coins posting gains of 1,000% or more. The debate over the long-term viability of crypto is heated, with one side believing it is essentially worthless, while the other believes that it will eventually replace fiat currencies like the US dollar. This massive uncertainty as to the true value of the asset class has made crypto notoriously volatile. However, from a pure investment point of view, the risks associated with Bitcoin, Ethereum, Ether, or any other cryptocurrency are no different from other traditional assets, except the fact that the virtual coin market faces higher volatility. Analysts have clearly stated that all cryptocurrencies are risky assets, and wild price swings are common in the virtual coin trading space. This is likely to reduce as the asset gains wider mainstream acceptance, but investors should be clear that the crypto space at the moment involves high risks and rewards. In other words, you need to have a big risk appetite to gain from crypto trading. At the same time, investors should note that cryptocurrency is far more resilient than it appears. Bitcoin, probably the most well-known cryptocurrency, has had a 52-week range from $8,608 per coin to $64,788 per coin. It currently sits at about $33,000, or nearly 50% below its April 2021 all-time high. This type of volatility can test even the most risk-tolerant investor, making crypto more of a speculative play at this point than a true diversification tool. However, there's no doubt that crypto continues to gain visibility and acceptance, and for those that understand its risks, a small portfolio allocation may still be appropriate. After all this, bottom line is make sure your portfolio is diversified. Investment isn't just about putting money into something. Do your research, be prepared, and don't invest money that you aren't prepared to lose. Thank you so much for watching, and make sure you like the video and subscribe to the channel. We will see you on the next video.